With that said, how does the Fed receive a letter like that from politicians? What do you actually do when you get a smart note, as you did from Warren, Sanders and company?
Well, I mean, I won't speak about this particular case, but of course, Federal Reserve officials and certainly the chair get correspondence all the time, and including from members of Congress and the relevant committees. And I have every confidence that they will respond promptly and thoroughly to the letter.
To get inflation down means to get nominal GDP down. I spoke to Michael Darda, so good on this, earlier today.
Yeah, Mike's great.
And we are nowhere, Richard Clarida, near what I'm going to call normal nominal GDP. And the proportion now is we need to do a lot of work on inflation as real GDP, particularly domestic final sales, is quiescent. How do we get that down more rapidly? Is it to crush the housing market? What's the strategy to bring it down besides a blunt instrument of a rate increase?
Well, the instruments are blunt, and it would be great if the Fed had surgical tools, but it does not. It's basically tightened conditions through higher rates and letting the balance sheet run off. In terms of nominal GDP, it has certainly stepped down from the eye-popping pace. I think last year nominal GDP growth grew 12%, and obviously not consistent with the 2% inflation. It is downshifting. In fact, this year we've seen a slowdown in nominal private sector demand growth. The GDP growth we've had has really been bobbing around with inventories and trade. So, the Fed's tighter financial conditions have yet to really fully kick in. Most of the slowdown this year in growth has been coming from what I call the sticker shock of higher prices crushing up against nominal income growth that's not keeping pace.
Priya, I've got a couple of minutes on the clock, and Priya Misra, you usually give us a trade going into the decision and through the news conference too. What's that trade today, Priya?
I think the market really wants to see that pivot, so it's a short-term steepener. But I would say use this opportunity to reestablish flatness. I mean, I know the curve is inverted, but if the Fed is serious about inflation, and we think inflation is broad-based, sticky, I mean, even if it comes down, it's at 8%. Does it stabilize at 4%, which is much too high? I think the risks are to the front end of the Treasury curve staying high, the long end actually looking attractive. So I think more cuts should be priced into 24. We have only 100 basis points of cuts priced in. I think a recession is almost a done deal by the end of next year. So maybe it's not next year, but in 24, when the Fed starts to cut, I think they're going to have to cut a lot. So buying further out the curve, having flatteners on, it just may not be a 2 to 3 p.m. today trade, because I think the market's going to grasp anything that sounds somewhat like a dovish pivot.
Can't wait for this news conference. Priya Misra, just wonderful as always. And to you, Rich. Thank you, sir.
Thank
former
you.
Fed Vice Chair,
Thanks.
Richard Clarida. Your equity market shaping up as follows then, going into this one. The equity market down about 1/3 on the S&P. In the bond market on a 10-year yield to lower by about a basis point, just north of 4% there. What did you say then, Lisa? What did Priya say? They're going to cling to anything in the news conference, anything at all that resembles some kind of pivot.
This market is desperate for a pivot or a swivel or whatever you want to call it. To
Pick
me,
a word, choose a word,
really,
any word.
And you ask, does Rich Clarida, discuss this and look at a thesaurus? Maybe they do. They try to get a communication right. But the fact that the market is so desperate for a pivot highlights that they think that that's actually going to be some sort of rallying signal rather than a sign that the pain is that much more entrenched, which speaks to what Mohamed El-Erian is saying, is that perhaps the pressure is to stop too early.
Mohamed agrees with Clarida on this point, Tom, that at the moment the risk of doing too little still outweighs the risk of doing too much.
I agree.
There's many people, though, finding weakness in this economy, pushing back against that particular view. I believe Larry Summers on board with that view, too.
And you could take Professor Summers and Professor Clarida and Professor El-Erian, and you can combine them into a lot of antiquity there. And they remember that societies survived with higher nominal rates and a legitimate higher real rate. A lot of people playing the game today have never really experienced that.
Bill Dudley on top of that story, too. Here's the price action, then. 14 seconds away in the equity market, down 1/3 on the S&P 500, down 0.7% on the Nasdaq, on the Russell. Small caps negative 1.3% with your much anticipated Fed decision. Here's Mike McKee.
Straightforward, as anticipated, a 75 basis point increase in the overnight lending rate to a range of 3.25% to 4%. But they added 2 lines to the statement. Pay attention. This is important. Something for Wall Street to chew over. They adjusted the pledge that the committee anticipates ongoing increases in the target range will be appropriate, adding, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. And they added this sentence. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. No reference to any size of any ongoing increases. The rest of the statement is identical to September, including the economic assessment that we have modest growth, robust job gains, and elevated inflation. Once again, Russia is blamed for its war's impact on inflation and global economic activity. There's no statement, no mention of anything to do with the balance sheet, and the decision was unanimous. So something for Wall Street to talk about, but nothing definitive yet. We'll wait for Jay Powell.
We're going to talk about that right now. Mike McKee, thank you, sir. And stand by. Your equity market rallying off the back of those headlines, up by 0.4% on the S&P, the Nasdaq recovering just about unchanged on the session off the back of it. The front end of the yield curve dropping like a stone a little bit. We're down by about 7 basis points to 448 on a 2-year. Call it down 6 basis points at the moment. On a 10-year, we're down 5 basis points. With the yields lower, expect a weaker dollar. That's what you've got. Euro dollar spiking higher, up by 0.6%. Euro dollar just short of parity, but still climbing about 99.40, Tom, on euro dollar.
I wonder, John, if cumulative tightening, I love the phrase, it reminds me of my belt, but if you look at cumulative tightening, I wonder if that came from Vice Chairman Brainerd. It's a beautiful phrase.
Well, it's off the back of the speech, isn't it?
Well, off this market with the Dow up 300 points, SPX up 28 points, 0.7%. This is what, Lisa, this goes to the pivot discussion.
Yeah.
Do you pivot and sum the time series together?
There's some tension between 2 headlines here, Tom. On the one hand, they talk about the cumulative tightening and taking lags into account. On the other hand, they're still talking about ongoing hikes until rates are sufficiently restrictive. This has all been implied by the dot plot for a while. We're expecting another 50 basis point move in December. It's about how much further you go from there and how long you stay there through 2023, particularly if the economy is weakening around you. So the first move off the back of these headlines is equities higher, yields lower, dollar weaker. Though, Brammer, when you get to the news conference, you wonder where the emphasis will be in the press conference. And that's ultimately what these news conferences are about. It's about where the emphasis will be from the Fed chair. Which headline does he lean on? Just that little bit more.
And the fact that the market is rallying speaks to what Priya said, that basically this is a market desperate for that step down, and they're going to read into anything that he says as a step down, which is the reason why the comment that Michael McKee highlighted, it will take cumulative tightening and lags into account as they decide to raise rates. This really speaks to John to that moment.
Tom, quite a moment. Hey, we look for the news conference in about 27 minutes, and looking forward to it, I've got to say.
It could be interesting to see Michael McKee with us here briefly into the conference. And Scott Miner joins now, Global CIO of Guggenheim. He's been just wonderful with us over the many Fed meetings of this historic moment. Scott, there's a new phrase, cumulative tightening. What does that signal to you?
Well, I think it's a very artful way of the Fed getting off the hamster wheel of 75 basis points a meeting and not having to focus so much on, what is the rate change at the next meeting and what is the pace, but to say, hey, guys, we're going to do what we have to over whatever period of time to get us to, something that brings inflation down. So, Tom, you knew this we've seen this every meeting, and between is, the debate about what's the pace and so on and so forth. I think they want that topic off the table, and they want people to focus on the terminal rate.
And Scott, what's so important here, and I don't want to do a wonk fest here, but it reminds